All right, welcome back. You're watching Hot Stocks right here on ED Now. As promised before the break, let's touch base with an important global voice in Dr. Marc Faber, editor and publisher of the Boom and Doom report, joins us on the phone line from Singapore to put the latest global events in perspective. Dr. Faber, thanks very much for speaking with us. The Jackson Hole event, what was your summary and key takeaway of what's been given out? It's really been a reiteration that things are going to be looking bad in the near term.
Well, basically, the Jackson Hole meeting didn't produce anything that we investors didn't know before. What was basically articulated by the Fed chairman, Mr. Bernanke, is that if conditions warrant it, there will be more QE3. And I think the conditions will eventually warrant more QEs, and there will be QE3. The question is, when will it happen, and to what extent have actually equity markets and also property markets in the U.S. already discounted QE3?
Right. Do you think that's reflected in the way the Dow Jones, the S&P 500 have performed year to date so far? And as you pointed out, the property market. So even if a QE3 does come by, we would perhaps not see the kind of rally that we've seen in the past QE announcements.
Well, we have to distinguish several factors. First of all, on QE1, the market in March 2009 was unbelievably oversold. And so the market was ready for a rebound regardless. And as you know, if you print money, it goes somewhere. And in the U.S., it went principally into equity prices and into corporate profits. We have record corporate profits, which is unusual because revenue growth is actually very disappointing. There's very little revenue growth, but they are record profits, and I don't think these profits are sustainable. Moreover, the markets are no longer oversold. We are above 1400 on the S&P, and compared to other markets in the world, say if you compare the performance of the U.S. stock markets to foreign markets over the last 18 months, in other words, since early 2011, the U.S. market has outperformed just about anything else. And therefore, I think actually by international comparison, the U.S. market is quite high. And my view would be every central bank will print money, including the ECB directly or indirectly, whatever they may call it, but they'll do it. And the European markets, some of them like France, Italy, Spain, Greece, Portugal, 2 months ago were either below the 2009 low or close to the 2009 low. On the S&P, that would be the equivalent of 666. So relative to other markets, some European stocks are now very inexpensive.
But would inexpensive valuations in certain pockets which have been weak, Dr. Faber, present an opportunity to get into investment mode out there? Because if we see various asset classes the last couple of months, at least the last month, commodities have been the ones which have outperformed significantly. You think it's the turn of equities, cheaper equities, to now start outperformance?
Well, I mean, you talk about commodities having outperformed stocks. That is not quite correct. Agricultural commodities have done well recently, but say industrial commodities have underperformed equities over the last 2 years. And I would say the opportunity, in my opinion, and as I have written about this in my report, is essentially to now pick up some European shares at very distressed valuations. 2 years ago, a book was published, Invest in Europe Now. Of course, the timing wasn't particularly good, and the markets since then in Europe have completely imploded. Now, recently, the markets have bounced off their lows in the case of Italy, Spain, Portugal, and France by between 18% and 30% from the lows in June, July. I think a correction is now coming, but I don't think we will see new lows, because whereas 2 years ago sentiment was very optimistic about the euro and about Europe, now it's at an extremely negative reading. There's nobody that has anything favorable to say about Europe. And I agree, there's not much favorable to say, but stocks, they are a discounting mechanism, and I think they have pretty much discounted all bad news, even if the euro falls apart.
Dr. Faber, the other bit is, I agree with you that over the last 2 years, sure enough, there has been a bout of underperformance by certain commodities, but I was just reading up some data on how the S&P GSCI total return index of 24 commodities for the last 2 months has done well. Considering that for the last 2 years, commodities haven't really performed as well, you think this could be a start of a larger rally in commodities, or is it difficult to predict right now?
I'm not that optimistic that we are at the beginning of a larger rally in commodities in general, because I think that industrial commodities will remain under pressure due to the fact that the Chinese economy is slowing down very considerably. But if someone came to me and said, look, the agricultural commodities will continue to go up, that may be the case. I just don't play agricultural commodities because I want to sleep at night and they're extremely volatile, and to buy ETFs is very undesirable because of the high rollover costs.
Right. Dr. Faber, coming to India now, it's very strange because despite all the macro concerns in the market has actually outperformed other emerging markets in the year to date so far. Do you think that at these levels there would be perhaps more downward pressure, or could we touch 2012 highs by the time we close out the year?
Well, basically, in India, the stock market has rebounded and the currency has been weak. And I think that if India decides to, like the other central banks, print money, the currency may go down and stocks and property prices may go up. I think that for the next 3 to 6, 9 months, equity markets will rather go down than up, and that a better buying opportunity will occur at some point in this period over the next 9 months. But if you ask me, should you invest money in India for the next 5 to 10 years, then I guess that for the next 5 to 10 years, the Indian market will move up and the currency will move down.
Okay, Dr. Faber, we will leave it at that. Appreciate you taking the time out and joining us for this perspective. That's the author of the Gloom, Boom and Doom report, speaking on the global macro, and of course a word on India as well.